In this video, we're going to look at working capital management. Generally, working capital means that the fund that you require to run your daily day-to-day operations is what you call as working capital. Now, net working capital is generally the difference between your current assets and current liabilities. So, in this topic, working capital management, you're going to look at the ways by which you can manage your current assets and current liabilities so that you have good amount of short-term liquidity. So that is what you're going to look at in this particular topic. Okay, and when it comes to working capital management, cash conversion cycle is one of the important measures for working capital management. What this cash conversion cycle means is that it denotes the time period between the time that you pay for your inventory to the time that you receive for your sale, the time that you receive the cash for your sales. So the time between these two events is what you call as cash conversion cycle. So cash conversion cycle is the time between the payment of uh, cash for the inventory that you have purchased to the time that when you receive cash for your sales. Okay, so that is your cash conversion cycle. So basically, cash conversion cycle, when you calculate cash conversion cycle, you will get the number of days that a certain amount of investment is going to be held up in your current assets. So that is what this cash conversion cycle is going to tell you. Okay, to calculate this cash conversion cycle, the formula is average age of inventory plus average collection period minus average payment period. Okay, average age of inventory is nothing but the number of days that the raw material or finished product stays in your inventory. Average collection period is the number of receivable days, the number of days that you take to collect your receivables. And similarly, average payment period is nothing but the payable days, where the days that you take to pay for your purchase. So average age of inventory plus average collection period minus average payment period will give you the cash conversion cycle. To understand this better, we'll look at an example here. Okay, let's say that you purchase raw material on Jan 1. Okay, and you are making a sales on Jan 11, which means that the material is there in your inventory for about 10 days. So the average age of inventory is 10 days. Now you have you have made the sale on Jan 11th. Now you're going to receive the cash for the sales on Jan 30th, which means that after 20 days of your sales you are collecting the cash for your sales, which means that for these 20 days the sales would be in your receivables. So the average receivable days is 20 days. Okay, now let's also assume that when you made the purchase on Jan 1, but you're going to make the payment only on Jan 15th, which means that you take an average of about 15 days to pay for your purchase. So which means that your payable days is going to be 15. So now if you consider the time between the payment for your purchase and the cash received for your sales, it will be 15 days. So you are paying for your raw material on Jan 15th and you are collecting the cash from your sales on Jan 30th. So the cash conversion cycle for this particular transaction is 15 days. Okay, if you use the formula to calculate this, average age of inventory is 10, the receivable days is 20, so 10 plus 20 is 30 minus 15 days for your payable, which will give you the answer as 15 days. Now if you look at the formula, the average age of inventory plus average collection period is what you call as your operating cycle. Operating cycle generally is defined as the time that you purchase your raw material to the time that you make cash out of your sales. Okay, the major difference between operating cycle and the cash conversion cycle is that operating cycle starts to the time that you have purchased the inventory. Okay, whereas cash conversion cycle, the time starts as soon as you pay for the inventory. Okay, so that is the major difference between the operating cycle and cash conversion cycle. Okay, now let us look at a question where we are going to calculate the amount of or the investment that is being held up in your current assets during this cash conversion cycle. For example, in this question there is a company which has an accounts payable which pays accounts payable on 12th day after purchase, which means that the accounts average payable period or average payment period is 12 days, and the average collection period is 30, and the average age of inventory is 40 days. The firm currently has a sales of about 18 lakhs and purchases of 12 lakhs. The firm is considering a plan that would stretch its accounts payable to 20 days. So it is considering to change its accounts payable from 12 days to 20 days. Okay, now for any borrowing that the company has to make, it has to pay an interest of 12% per year. Okay, and we are going to assume that there are 360 days in a year for this particular question. Now let's start with calculating the cash conversion cycle. Okay, so the cash conversion cycle here is average age of inventory plus average collection period minus average payable period, which is 58 days. Now what we're going to look at is what is the amount that are being tied up in these areas. For example, what is the amount that is being tied up in inventory, what is the amount that is being tied up in accounts receivables, and what is the amount that you have with you by delaying your payment. So those are the things that we are going to calculate to find the total amount that is being held up in your current assets. Okay, why we are finding this total amount that are being held up is this amount, if it was available to you, you would have used it for a different purpose in your operations. Now since this amount is being held up in your current assets, if at all you need any money or any cash, you have to borrow at the cost that is being mentioned, which is 12%. Okay, so we are going to look at what is the investment that is being held up in each of our in inventory, in account receivables, and in account payable. Okay, now let's start with investment in inventory. So to start to look at the investment in inventory, we are going to consider the amount that we spent on purchase, which is 12 lakhs. We have spent 12 lakhs in purchasing raw material, so I'm going to consider that. Okay, that is the annual amount that you have spent on purchase. Divide that by 360, which will give you the purchase value for 1 day. Okay, now the average period or the average number of days the purchase spends in inventory is 40. Okay, so 12 lakhs divided by 360 into 40 will give you the value of purchase which is being held up in inventory for those 40 days. Okay, so 1,33,333 is the value of or is the inventory value which is being held up for this 40 days. Now the cost of this investment in inventory. Okay, now since 1,33,333 is being held up, okay, if you need this amount, you have to borrow. Okay, now we are going to look at what is the cost of this amount which is being held up in inventory. So the value of investment which is being held up in inventory into the cost at which you have to borrow money. So will give you an answer of 16,000 rupees. So the cost of investment in your inventory is 16,000 rupees. Similarly, you're going to calculate for accounts receivable. The investment in account receivables. Account receivables is nothing but sales which are yet to be realized into cash. So I take the annual sales value of 18 lakhs here, divide that by 360 to get the sales value for 1 day. Now the account receivables is the number of days the sales stays in account receivable, which is 30 days. So 1 day sale value into 30 will give me 1,50,000 rupees, which is the amount which is being held up in accounts receivables. Okay, so again, like what we did for inventory, we are going to calculate the cost of investment in account receivables. So we take 1,50,000 and multiply that with the cost, which will give you 18,000 rupees. Okay, similarly we are going to look at the amount that or the investment that is being held up in your account payable. Okay, accounts payable is for your purchase, so you take the purchase value of 12 million, divide that by 360 into the number of days of payable, which is 12, so which is equal to 40,000 rupees. Okay, so the investment in your accounts payable is 40,000 rupees, and the cost of that investment is 40,000 into 12%, which is 4,800. Now if you consider the total cost of investment which is tied up in your total cash conversion cycle. Okay, so if you look at this, the cost in inventory and and accounts receivable are the cost that actually the cost that you are incurring, whereas the cost that you have calculated for accounts payable is something that you are saving, because instead of paying out to your supplier, you are keeping that cash with you, which can be instead of borrowing, you can use that cash. So you're going to add the cost of inventory and the cost of accounts receivable, and then subtract the cost of accounts investment in accounts payable. Okay, so you're adding the cost of investment in inventory, the cost of investment in your account receivable, and you're subtracting the cost of investment in your accounts payable. Okay, why we are subtracting the cost is because the accounts payable generally means that you are delaying your payment to your supplier. So by delaying that, okay, you are keeping the cash with you, and keeping the cash with you means that instead of borrowing that amount from outside, you can use that amount. Hence we are subtracting that cost from the other two costs. So the total cost is 29,200. Now we are going to look at if that accounts payables was increased from 12. Okay, what will be the cost, what will be the new cost? Okay, so under your new plan, nothing is going to change except for your accounts payable. So you're going to the investment in inventory is the same, the investment in your accounts receivable is the same, and similarly the cost of investment in your inventory and the cost of investment in your account receivable all is going to remain same, because the change is only happening for your accounts payable days. Okay, now we are going to look at the investment in your accounts payable. Again, you are considering the value of your purchase, divide that by 360 into the new payable days, which is 20. So this is your new investment in your accounts payable. So you calculate the cost for this new investment, which is about 8,000 rupees. Okay, now you are calculating the total cost of your investment tied up in your new cash conversion cycle. So it will be 16,000 plus 18,000 minus 8,000. So your new cost is 26,000. If you remember, the previous cost was 29,200. Now the cost is 26,000. So the cost is actually coming down because of the increase in your accounts payable. Okay, so you can go ahead with the new plan and you can implement the new. Next, we are going to look at inventory management. Okay, inventory is part of your current assets, and when you maintain inventory, there are certain costs that you're going to incur because of the inventory. Okay, so we are going to look at a method which will tell you the optimum level of inventory that you have to maintain, so that your total inventory cost is at a minimum. Okay, generally inventory cost will involve two types of cost. One is the ordering cost and another is your carrying cost. Ordering cost is nothing but the cost that you incur in placing an order for your inventory. Okay, that is what ordering cost is all about. One carrying cost is the cost that you spend in holding that inventory. For example, let's say that you're holding that in a warehouse and you're paying rent for the warehouse. Okay, so that rent would be part of your carrying cost. Okay, now the ordering cost will is a function of the number of orders that you place. Okay, the ordering cost will increase or decrease depending on the number of orders rather than the number of units that for which you place the order. Okay, but on the other hand, the carrying cost will increase or decrease depending upon the number of units or the number of units that you have in your inventory. Okay, so these are the two costs that you have in your inventory cost. Okay, so now we are going to look at a method or yes, a method by which you can have this inventory cost at the minimum that is possible. Okay, the name of this method is economic order quantity or EOQ. Okay, what this method tells you is that what is the optimum level of inventory or the optimum number of units that you have to place in an order, so that the total inventory cost is at the lowest possible. Okay, I'll repeat it again. Economic order quantity will tell you the number of units for which you have to place an order, so that your total inventory cost is at the lowest possible. Okay, the formula for to calculate the economic order quantity is square root of 2 into S into O divided by C. Here S stands for the number of units that you use in a period. let's say that the period is 1 year. So the number of units that you use in 1 year is what you term as S, and O is the ordering cost for one order, and C is the carrying cost of 1 unit of inventory in a given period. Okay, so this is a formula for economic order quantity. Okay, now to know what is the level, or what is the number of units for which you have to place the order. The next concept that you are going to look at is at what point should you place the order. Okay, at what level of inventory, or when the inventory reaches certain level, you're going to place order for new inventory. What is that level? Okay, we call this level as reorder point. Okay, the reorder point is nothing but the level of inventory when reached the new order for new inventory is placed. Okay, generally reorder point is calculated using the formula days of lead time into daily usage of units. Okay, when we say days of lead time, it means that the number of days that it will take for the supplier to fill back your inventory with new units as soon as the order is received. For example, let's say that you place an order today and it will take 3 days for the supplier to give you the supply you with new raw material. Okay, so these 3 days is the lead time for your order. Okay, you have to ensure that you already have inventory to cover these 3 days. Okay, so when your inventory level reaches to a point where you have only 3 more days of inventory, you will place the order for new inventory. Okay, so the reorder point is the days of lead time into daily usage of units. Daily usage of units is nothing but how much of inventory are you using for in 1 day. Okay, so if the lead time is 3 days and you're going to use 10 units in a day, you should have when the inventory level reaches 30 units, you will place order for the new inventory. Okay, and sometimes there will be certain level of safety stock which is also maintained in your inventory. Okay, when there is a safety stock which is maintained, your reorder point will change. Okay, the main purpose of the safety stock is to ensure that if suppose there is any change in lead time, you don't face with stock outage. Okay, now let's take an example. Let's say that the lead time is 3 days and you intend to maintain another 3 days of stock as safety stock. Okay, so when you have an inventory level which is equal to 6 days of level, for example 6 into number of usage daily or units that you use daily, let's say 10. 6 into 10, when the inventory level reaches 60 units, you will place an order for a new inventory. Okay, so though that is the objective of having safety stock. Okay, now using this, let's look at a problem and calculate the economic order quantity. Okay, uh, so there is a pizza company which uses 50,000 units of cheese per year. Okay, each unit is going to cost rupees or $250. Okay, the ordering cost for the cheese is 250 per dollar, $250 per order, and the carrying cost is $0.50 per unit per year. Okay, so we are going to calculate the economic order quantity. Okay, and we are going to consider that it operates for 250 days per year, and it has to maintain a minimum inventory level of 2 days, so this is nothing but the safety stock. The lead time to receive the order is 3 days. Okay, now we are going to calculate the economic order quantity and the reorder point for this particular question. Okay, economic order quantity, you are simply going to substitute the values into the formula that we have. So 2 S is 50,000. Okay, S is 50,000 and ordering cost was 250 and the carrying cost per unit was 0.50. So the unit is 7071.068. So this is the economic order quantity, or the quantity of cheese for which you have to place an order so that your total inventory cost is low. Okay, now you're going to calculate daily usage of units. Why we are calculating the daily usage here is to calculate our reorder point. Okay, you are using 50,000 units in a year. Okay, and it was given the question that they work for 250 days in a year. Okay, so 50,000 divided by 250 will give you 200. So 200 units of cheese is what they are going to use every day. Okay, and the safety stock, they are expected to maintain the safety stock for 2 days. Okay, so 2 into daily usage of cheese, which will give you 400 units. So 400 units of cheese is your safety stock. So now let's calculate the reorder point. The lead time was 3 days. 3 into 200 plus the safety stock, so 1000 units. So when the inventory level reaches 1000 units, you will place for a new inventory of cheese, and that order will be for 7071.068 units of cheese. Okay, generally when you represent the units, it will be a whole number, so probably you can round it off to the next whole number. So this could be 7072 as well. Okay, thank you.